The Nasdaq is back to breaking record highs. It looks like the stock market crash is over. Or is it? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. The temperature is getting warmer, the NBA is coming back to life, and the stock market is unstoppable, with the S&P 500 seeing its best 50 days in history. After the fastest stock market crash in history, the Nasdaq has fully recovered and has actually hit new record highs. But before you jump and declare victory, woohoo! Our economy still isn't in the clear yet. June is the last month of the second quarter, and what you're probably going to see happen is experts are going to come out in July and say something like the United States economy shrunk during the second quarter of 2020. So that's April, May, and June. If that happens, then we will officially be in a recession, because in order to enter a recession, you need to see 2 quarters or 6 consecutive months of economic slowdown, and this could bring in a new wave of negative press. Or it could spark discussion of the fastest economic recovery in history. I don't know. Right now, we have about 43 million Americans living off of unemployment, which is bad news. But the good news is that in May, the United States economy actually added a couple million jobs, which is way more than what experts expected. Couple the economy opening back up with good news about jobs, with unlimited government money being pumped into the markets, and you get a stock market that cannot be stopped. Hey Gucci, I just sold my Tesla stock. What you got? If you are confused or skeptical about what's going on in the stock market, you're not the only one, which is why in this video, I want to go over what's happening in the stock market and the economy. So make sure you watch this video until the end, because you want to know how you can capitalize on what's going on around us. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel, that way you don't miss our new financial education videos every single weekend. Hit that little notification bell too, because if you don't, then YouTube won't let you know when our new videos are released. The stock market is supposed to be a reflection of the economy, where investors can go in and invest in companies based on what they think is going to happen in the economy in the future. But it's not a mirror image. I mean, our stock market is pretty much back to where it was before this whole pandemic started, but our economy isn't. Part of the reason for that is because our stock market got bailed out by the Federal Reserve Bank. In May, the Fed started their program of pouring money into the stock market by buying corporate bond ETFs for the first time in history. This didn't even happen during the 2008 crash. That means that the Fed would print money at your expense, and then they go onto the stock brokerage app and buy over $1 billion worth of ETFs to pump up the price of these ETFs and the stock market. Did you say that your investment is crappy? I'll take 45 million shares. This was a way for the Fed to give huge sums of cash to institutions that were holding on to toxic assets that were now worthless, that they couldn't sell, and they could pump up the stock market at the same time. After that, the Fed created the Main Street Lending Program. Typically, the Fed can only lend money to banks, but because of this economic crisis happening, the Fed invoked some of their special powers, which would allow them to lend money not to banks, but to businesses. The Main Street Lending Program allows the Federal Reserve Bank to go out and print $600 billion at your expense, and then they can take this money and loan it out directly to businesses making less than $5 billion a year, and this program is going live right now in June. This was another way for the Fed to pump money into struggling businesses that now could not qualify for money or loan anywhere else. And now, to top it all off, it officially does not matter to Wall Street if you lose your job. Actually, they kind of like it that way. Every time a new jobs report comes out, here's what happens. First, experts are shocked by the number of Americans that lost their jobs, and then the stock market rallies. Normally, if people are losing their jobs, the stock market would tank, because if people don't have jobs, they don't have money to go out and shop at Amazon, Lululemon, Apple, and Kroger. But the Fed is working with the Treasury Department to print billions of dollars to fund these unemployment programs and stimulus programs. So people are losing their jobs, which sounds bad. But it's nowhere near as bad as it could be because of this unemployment program, and half of Americans in this unemployment program are actually making more money in unemployment than they did while working a job. So Wall Street is loving it, because now people have more money to spend at Amazon, Lululemon, Apple, and Kroger. This creates a lot of positive emotion, and Wall Street gets excited and the stock market goes up. However, before you get caught up in all the stock market emotion, I am a stock market genius. I need you to remember that the best investors are not the ones that invest emotionally, it's the ones that invest financially, which is why I'm going to try to give you a balanced approach as to what's going on right now. The stock market is very emotional, and it's excited because we're hearing good news about the economy for the first time in months. The good news is states are finally opening back up, which gets Wall Street excited. However, experts are worried about a second wave of this virus because it looks like cases are spiking in Texas, Oregon, and Arizona. The good news is people are spending money, and some businesses are seeing record revenues in the middle of an economic crisis, and Wall Street can't believe their eyes. But a big piece of this is because of all the free money out there. You know, unemployment checks, stimulus checks, and bailouts, and this free money will eventually go away, and there's a cost to printing all this money. The good news is some businesses like tech and e-commerce are growing faster than they've ever grown before, and Wall Street is losing their mind. But other industries are fighting for their lives, like restaurants, retail, and travel. The best case scenario is that by the time all this government free money goes away, the economy will have recovered so people can get a job again and people can go outside without worrying about getting sick. The worst case scenario is that by the time all this government free money goes away, the economy hasn't recovered so people can't get a job and this virus resurges and now people are worried about lockdowns again. Here's a quick tip. Things are typically not as bad as the media makes it seem during downtimes, and things are typically not as good as the media makes it seem during uptimes, so you want to take things with a grain of salt, especially when it comes to the stock market. Remember, the stock market is emotional, and the media is in the business of selling emotion, because if they can get you riled up, then they make more money. If Wall Street gets worried about another round of lockdowns, or if businesses and the economy start struggling again, then chances are we're going to see the stock market come right back down. Right now, 2 out of 3 professional fund managers don't believe in the stock market rally. They're calling this a bear market rally, and they're telling investors to brace themselves. But all the retail investors, so these are your non-professionals, the people trading on Webull and Robinhood, are saying, "You fund managers know nothing. I just doubled my money in 60 days." A bear market rally, according to Forbes, paraphrased by yours truly, is when we are in a bear market or a downward stock market, and then the stock market recovers because people are hopeful for an economic recovery, but then people realize that the economic recovery isn't here yet, so then the stock market comes back down. Over the last 2 decades, between 2000 and now, the stock market has seen 5 bear market rallies. If the stock market goes back down, this would be the 6th. By the way, if you do want to invest in stocks, you have to use a stock brokerage like our sponsor Webull. Webull is completely free to use, and they are giving Minority Mindset fans free stocks just for watching this video and using our link to create a free account in the description below. The 2 things you want to keep your eye on as an investor are the economy and the virus. Our economy has a lot of uncertainty right now. Obviously, there are a lot of Americans without a job right now. But the bigger question is, how many Americans will have a job once these unemployment checks go away? We finally saw the job market stop crashing in May, which is great news. But we still have a 13% unemployment rate. It's actually kind of a really weird dilemma because right now so many people are making more money in unemployment that it doesn't make sense for them to go back to their job. So the government is actually proposing paying people to go back to work. Lawmakers have actually proposed a government bonus check where the government will pay you something like $450 a week just for going back to your job. It feels like the government is our parents and we are being complimented for tying our shoes. Aww, good job pooping. Here's $400. This program hasn't been fully passed yet, but there are a bunch of different stimulus measures being discussed right now, and what you should remember as an investor is that Wall Street loves stimulus programs because when people have more money, especially when they get free money, they have more cash that they can spend at businesses that trade on Wall Street. And on a broader level, we have a debt problem. Interest rates are already at 0%, which means that if our economy stays slow, then the Federal Reserve Bank will have to take more drastic measures to try to stimulate the economy. And our national debt is ballooning faster than ever. The famous hedge fund manager Ray Dalio talks about something called a long-term debt cycle, which I'm not going to go over too deeply in this video, so if you haven't subscribed yet, make sure you do that. But essentially it says that every 75 to 100 years or so, you see a major debt crisis. The last time we saw a major major debt crisis was in the 1930s, around the Great Depression time. I'm not saying this debt crisis is going to happen right now. Maybe we'll push it off until the next economic crash in 10 years. But it's something you want to keep your eye on. If you are looking for an easy way to stay up to date on what's happening in the top finance and business news, well, that's why we created our free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. This newsletter is completely free, and you can subscribe to our finance and business newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are separate from our financial education emails. And this brings me onto the topic of a vaccine. I'm not really going to talk about the health aspects of this because I'm not a medical professional, but I want to talk just practically speaking. We have a chunk of the country that's fed up. Either they don't care about the virus or they don't believe in the virus. Whatever it is, they're out living their lives like normal. You have another chunk of the country that says, okay, we are worried about the virus, but we're going to take our precautions. We're going to wear masks and gloves, and we're going to live kind of a more limited lifestyle for a little while. And then you have one more chunk of the country that says, I am not going outside or touching anything or going anywhere until there's a vaccine and this virus completely goes away. What this tells me financially is that there is a chunk of the country that will not go out and spend money like normal until they feel safe going out, either when this virus goes away or until there's a full vaccine. That's their problem. I'm going to the gym. Yeah, it's an individual's choice to not go out and spend money, but you have to think that, okay, if let's say 20% of the country is not spending money, then businesses are gonna feel that. We really don't know how many Americans fall into each chunk. I mean, we can guess, but we're really not gonna know until time goes on. That 20% number I said was just something I threw out there. So this is something you wanna keep in mind, especially as an investor. And again, if you're looking for an easy way to stay up to date on what's happening, I got the link to our newsletter in the description below. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you're looking for tips on how to succeed at investing in the stock market, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.